Okay, good morning, guys. So let's just talk Fed minutes and then have a look at some of these moves and talk about the day ahead. You know, to start with, you can see, look at my top two charts, then equities are on the up still. This rebound off 2000 for the S&P continues. Here we are trading 2085. So upside off or after the Fed minutes yesterday. The DAX perhaps more important technically. Yesterday's high bang on the November top from the 6th of November. Well, it's not the November top anymore because we're up through that, briefly trading up through 11,100 this morning. So what is that? 1, 2, 3 month high for European stocks. Let me just check on, yeah, actually Euro stocks just shy of that. So Euro stocks yet to take out the, let me just bring that chart in, the Euro stocks price point to be aware of, 3,482, which is the 6th of November top. The DAX has gone above that, Euro stocks not yet. The German equities just outperforming this morning marginally. Other points of note technically, and sticking kind of to the German theme, the Bund 10-year here moving up through, and you know, we've been flirting with this October the 2nd high all week really. It was roughly the high of the day on the 17th of November. We kind of chopped around it yesterday and basically closed on that price. Now we've taken the March higher. So the Bund pushing higher, yields now dropping below the 0.5% handle. We had some auctions from Europe yesterday, not on the 10-year duration, but we had a 3-year German bond, or was it a 2-year? 2-year German bond auctioned yesterday with a yield of minus 0.38%. We had a Portuguese, I'm going to get the duration, no, yeah, it's a Portuguese 12-month T-bill auctioned at minus 0.006%. So you got negative Portuguese yields out to 12 months, despite the slight flare-up in political risk over the last few weeks. Who is it? Sweden auctioned negative yields yesterday as well. So, you know, we've definitely seen yields drop as we head towards what is now just 2 weeks away, the ECB press conference for December, 2 weeks today, and these markets continue to price in the ECB definitely doing more, and not just doing more, doing a lot more. So cutting rates and a QE extension. This is what markets are expecting. And when market expectations rise to sufficient levels, then really, ultimately, the ECB gets backed into a corner and they're forced into doing what they've been promising. So they kind of have to deliver in 2 weeks. And that maybe has implications for the Fed, like we were talking about yesterday. So let's talk about the Fed and talk about the minutes. So the meeting that took place 3 weeks ago, we got more insight into this last night as the minutes from that meeting were released. So this is discussions that took place 3 weeks ago, which was before the very impressive non-farm payrolls number. So bear in mind, these comments came before that 271K on the payrolls for October. So this is kind of some of the insights. Before I go through this, I think Bill was covering this kind of live last night, and his feeling when the information flow poured in was actually it was slightly dovish. And you kind of saw that to a degree in some of the market reactions, where you got a bit of dollar weakness, you got T-notes pushing higher as yields dropped, and you got the S&P kind of pushing higher, and then, you know, we're trading up above yesterday's highs now. Let's maybe go to a 1 hour chart on some of these markets just to get a sense of the shorter term movement. Let me just change my charts to 1 hours. And you can see that last night at 7 o'clock, when the minutes were released, that's when the S&P made the move and broke up through the high from Tuesday. In terms of the dollar movement, well, yesterday at 7 p.m. It was very choppy. We got some dollar strength, some dollar weakness. It settled down, and then the dollar weakened into the close and weakened overnight. We pulled back now. In terms of bond market, certainly with the Bund, the Bund pushed higher, and then just now this morning we broke up to make this new high. So slightly dovish moves, except that I'm not necessarily sure you should read too much into this in a dovish way. Here's what they said. The minutes confirmed that, quote, most participants anticipated that, based on their assessment of the current economic situation and their outlook for economic activity and the labor market and inflation, these conditions could well be met by the time of the next meeting. I.e., most members expect conditions to have got to the point where they can hike rates in December. Members emphasized that this change was intended to convey the sense that whilst no decision has been made yet, it may well become appropriate to initiate the normalization process at the next meeting. They said that, on the prospect for gradual rate rises following that first hike, this was acknowledged because in the text it said that it would probably be appropriate to remove policy accommodation gradually, and that it was noted that the beginning of the normalization process is relatively soon, and this would make it more likely that the policy trajectory after liftoff could be shallow. What I take from that is, look, we're going to hike rates in December. Maybe conditions aren't going to be nailed on perfect for a hike, but look, let's get going so that the overall rate hiking cycle can be at a shallower trajectory. I think this is definitely right. I think this is what they should do. Other things, more hawkish. So just in a sign that they were still not necessarily fully aligned there's not full alignment within the Fed camp. Some members believed the economic conditions had already been met for tightening, but then others judged it unlikely that information available by the December meeting would warrant a hike. So there's, you're always going to get your extreme hawks, your extreme doves. It's more about the center ground and what do they think. And yes, these minutes, there's something in there for everyone, like there always is. And the Fed can't pre-commit. They're data dependent. They can't say in October, we're going to hike rates in December, fact, guaranteed. They can't say that because they could look stupid come December if data dramatically takes a turn for the worse. So, of course, they're going to leave the door open and make sure that, the decision will be made and it is data dependent. But ultimately, from an expectations point of view, actually expectations rose. So the probability increased, not much, but from 63% to 69% for a Fed hike in December. Here's a very interesting chart for you. It's almost like my chart of the day. This is looking at ever-changing odds of a 2015 rate rise. This was in an FT article this morning. This is quite interesting. The red line, or the top one here, is what are the chances of the Fed hiking rates once in 2015? And as we go through the year, how the odds of a single rate hike have changed. And of course, they've trended lower until we got the October meeting where it all changed. And the minutes last night were from that meeting. And it all changed and we got a dramatic spike. And it went from 33% chance of a rate hike in December right the way up to above 60%. After last night's minutes, this hasn't changed. If you think those minutes last night were dovish and that we're not going to get a hike, I think you've interpreted it wrongly. Some out there have interpreted it in that way, but I think they've got it wrong. I think they're desperate. I think you've got a bit of anchoring here. If you think the Fed aren't going to hike in December, there's stuff in the minutes that supports that view. It's just that overall, there's more information that doesn't support that view, but you may have chosen to ignore that. I think they're hiking. Get used to it, and markets. I think it's interesting. The S&P's new highs this morning. Have we now properly got over the panic? Our market's now settled and not nervous anymore about the rate hike. Will it now? And I think that's right. And I think now it's actually much more important. Forget about whether they're going to hike or not in December. It's more about the communication in December's meeting, the communication about when the next hike might be. Now that's the new obsession. When's hike number 2 coming? And are the Fed going to indicate that they are looking to hike, let's say, once a quarter through 2016? That's not priced in yet. Or are they going to say, look, one hike and let's just see? That would be dovish, but you could spin that and say, well, okay, if they're worried that the economy can't even deal with one hike, then maybe we've got some serious issues. There's lots to think about. But I think this is quite an interesting chart. Look how the percentage chances have changed. Look at this line here, the 2 rate hike probability in 2015. Of course, that's now impossible. Well, sorry, it's not impossible. I guess this means raising rates by 0.5% rather than. It's impossible for them to hike rates twice because we've only got one meeting left. But does the 2 hike probability here, is that talking about a 50 basis point hike rather than a 25? Anyway, it's interesting to see how expectations change so dramatically. Right. That's enough about the Fed. We've responded. Yes, there's some dovish stuff in the minutes. Yes, there's some hawkish stuff in the minutes. I don't think it changes too much. And I think we move towards the meeting in 3 weeks' time, still expecting a hike. Okay, let's look at the day. Well, let's look at oil first before we look at the day ahead. Another key drop and test of the low of the week. Now, for this, I'm looking here at the January futures contract. The December, which is still the front month, it hasn't expired yet, hit $40 on Monday. This move lower here on the January contract meant that the December contract traded down and again tested $40, and again we bounced. 2 big tests of $40 this week, and as of yet, no break, but each rebound seems to be getting smaller. So you have got a downward trend here. So, the fact has 40 brought to an end this sharp downside that we've seen in recent weeks or not? And that question is as of yet still unanswered. It's done a good job on the first 2 tests. It's won the first 2 battles, but it hasn't won the war yet. So keep your eye on crude as we go through the session, obviously. Right, let's look at the calendar. A few bits of data this morning coming. First one, UK. Well, let's look at the calendar first. Here's the calendar. We've got retail sales coming out of the UK at 9:30. So on the headline, including autos and fuel, we're expecting a drop of 0.6% on a month-on-month basis. Oh, sorry, that's ex-autos. Apologies, that's ex-autos, not including autos and fuel. We're expecting a drop. If you add in the autos and fuel, we're also expecting a drop. So minus 0.6% on the headline. How does that stack up when you look at the chart? Well, we got a massive number last month. So this is why we're expecting a pullback. A huge reading, plus 1.9% on the month last time out. So perhaps not surprising. But if we do get minus 0.6, it will be the worst reading since March. Okay. Just looking at it on an annualized basis, again, massive month last month. Massive figure of 6.5%. So it's only natural we're going to get a pullback from these figures. Okay. This data is coming at 9:30. Then we have no other kind of European figures of any note. Eurozone figures, I mean. We've got Italian current account balance, but that's about it. So into the afternoon, we've got initial jobless claims. This kind of figures, basically irrelevant these days. It's so strong. It's been so strong for so long. You pretty much ignore it. 270,000 expected. That's very solid. Expected to remain very solid. So perhaps the big data of the day from the US is the Philly Fed number. And we're expecting a minus 0.3. We'll talk much more about this nearer the time, but we've had a couple of negative readings in a row, this is a lead indicator. So it's bad news, and we're looking for a third negative reading in a row, but albeit less negative than last month's minus 4.5. Just looking at the monetary policy speak, we've got Broadbent again due to speak, but he said so much yesterday. Hawkish yesterday from Broadbent, which helped to see cable take a lift and continue to recover from the losses that we got at the start of the month, when the Bank of England's sort of Super Thursday was very dovish on the 5th of November, and then we got the non-farm payrolls number on the 6th. It was like a double 1-2 punch that took cable down to a new low, multi-month low. It's just Broadbent yesterday has reversed some of that dovishness, Broadbent being hawkish. So we're continuing to retrace that 2-day big sell-off. So we've got lockout this afternoon, but look, this is after the European close, so perhaps a bit late in the day. So overall, I'd say a quiet session for data. You've just got the UK retail sales at 9:30, then you've got Philly Fed at 3 o'clock. They're the two to be looking out for. And in the meantime, it's continuing to digest the Fed minutes. And if you ask me, I think that there's nothing in it that tells me they're not going to hike. So to put that the other way around, I think the minutes tell us they're going to hike. So get used to it, and I think markets have, and this is the interesting thing. For the S&P to take a bullish move off those minutes, and it wasn't a small move. Over the couple of hours into the close, the S&P jumped almost 20 points, which I'm very surprised about, because I didn't see much dovishness in there. But maybe it is about this 200-day moving average. We've been having a conversation about this morning in the office. We have a 200-day moving average on my chart here, and we broke it. And it was really the Fed minutes that took us up above yesterday's high, or not yesterday, Tuesday's high, and really properly up through the 200-day moving average. So maybe this played a role. Maybe it was technical as well as anything else. Who knows? One idea. So 2100 back in the sights. I think just to finish off with, I've been talking about this trend in the S&P over the last 6 months, lower highs. And it's been the first time since really the crisis in 2009, it's really been the first time that we've had, over such a long period, had lower highs. And I'm going to draw a trend line. It's a very shallow trend line. It doesn't have much gradient to it at all, but it's a downward trend nonetheless. And I think it's really important going into year end for the, if this is going to be the top for now, if this is going to be a long-term rounded top after a 5-year rally, are US equities now fully priced? Is the economy strong enough for rate hikes? These kind of question marks. Is this delivering us a rounded top in 2015 for then sideways to downwards, perhaps as we go into the next recession, whenever that might be? Is that right? Well, this rally we're getting this week, 2100's in our sights, the big levels, 2111, 2110.50. If you get above that, well, then that ruins this argument that we're getting lower highs, because then we would get a higher high. So I think it is very important. I think ECB dovishness in 2 weeks' time, this is the thing. If the ECB deliver in style in 2 weeks, cut rates, extend QE, that might be enough of a catalyst for the S&P to drive up through some of these tops. And then throw in the argument, well, can can the Fed hike when the ECB aggressively cut? Can they hike? And what kind of risk does that bring? Because it might drive significant dollar strength that may well be enough of a force to hinder the economy meaningfully and, end up throwing the US economy back into recession. So it's kind of all to play for. We have a monetary policy divergence event coming before year end, and I think it's going to be very interesting. All right, that's it for now, guys. Enjoy the session. UK data in 22 minutes.